You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, let's jump right in here. We got a lot to talk about, a lot going on in the markets. Let's start by looking at what we did last week in the IWM, which is the ETF that tracks the Russell Index. We looked at, we did a play where we're looking for more volatility as opposed to less volatility. And that trade happened to be a back spread in the IWM. So let's review the trade real quick. And I want to talk a little bit about it because the trade actually hasn't worked out well. There was a point in time where it would have been profitable overall. You did get a move in the direction we were looking for. But I like to talk about it. I feel like we learn more about trades that don't go well as opposed to trades that always go well. Because if you got a gain and you sell it, well, that's pretty simple to be able to figure that all out, what you're going to do with it. But on trades where they go against you, I just want to talk a little bit about the pricing. And what we said on Options Playbook Radio last week was that the volatile marketplace makes it very interesting to do trades like this. We saw the RVX come down precipitously. That's the VIX that tracks the Russell Index. And what we were looking for is more volatility as opposed to less volatility. So last week we taped on November 11th. The markets were closed. It was a Wednesday. The last trade in IWM was 172.63. So we went out and went all the way up to the December 4th expiration, which helps us out here because those option contracts are still living. So it makes it so we can actually get a quote on the underlying stock and on that trade, on that strategy overall. And once the very next day that we put the trade on, the market did go down. We were hoping that it might fill a gap, go down to about 165 was kind of what we were looking at in the charts. But we got a little bit of a spike down, and then it came back up, which means it's a failure. So it's going to the upside normally. I mean, in a charting world, it never a guarantee of anything, obviously, especially in the Russell 2000 index. So here's what we did. We sold the 180 put, which would have been an in-the-money put with the stock at 172.63. And then we used that credit to pay for two at-the-money puts, which is the 172.50 strike, which is very close to at-the-money, just a few pennies away. We did it for a net credit of 11 cents to the account. And if you're doing this trade, you're kind of hoping for a 7-point move or the width of the spread, which is actually would be 7.5 points overall. That's the width of the spread. So if you're doing a trade like this, you're expecting that type of move in one direction. And we mentioned on the show that the worst thing that could happen is the stock goes down 5, comes back up 5, goes up 2, then goes down 3, where you get the volatility, but it's not just in one direction. And that's kind of what has happened. Today, we're taping Options Playbook Radio. It's November 18th. It's a Wednesday. And the market did set a new high in the Russell 2000, which is good overall for the markets. We like to see the small caps leading the way higher. Normally, that is a good thing, especially when there are concerns about a recession, because normally the small cap stocks don't do as well. And on top of it, there hasn't been a lot of talk about stimulus. So to see the Russell 2000 set a new high is really quite good overall for the markets. With that said, it's not good for our trade, but it doesn't hurt our trade, because if the market actually on December 4th closes above 180, the put that we sold, all the options expire worthless, and we would receive the net credit on our account of 11 cents. And that would be a good thing overall. But that was our bailout trade, and that we did this trade long, one more put than we were short. We wanted a big move to the downside. It kind of faked us out, gave us a little head fake, and then went back up. Now, the reason why I talk about this is because we set up this trade and we were able to go out further in time because of the volatile marketplaces overall. We now are down about 60 cents on that trade. The market went up to I'm going to round up a little bit to 176. Selling that, if I were to go out and close this position, I would have to buy to close the 180, one contract, and I would have to sell to close 2 of the 172.50s, and that would be done for a net debit of 75 cents to the account. We put it on for about 10 cents, so we're looking at a 65-cent loss on this trade, and the market's gone fairly hard against us. It's gone up almost 3 points since we put it on, and the reason why we have a small loss in this account, only a small loss, is that we have plenty of time and we still have some volatility in the marketplace that is making our 172.50 strike put worth something overall. So if we look at this trade, we still have until December 4th. Today is November 18th. So we still have a lot of time remaining on this trade, and we could just let it ride. We basically said that the time value and the volatility premium is a protector if that underlying happens to be within the width of the spread or within that range that we're talking about, basically 7 points to the downside or 7 points to the upside. And we only have about 14 days or less remaining till that expiration date. We're just going to close it and get out. And we should have the protection of this trade because of the way that we set it up. So we were looking for a strong move to the downside. We didn't get it. We set it up correctly overall. And that's what's kind of interesting about trading in this environment. So we can even come back next week and we can see where this trade is at. I'll take a screenshot of it and we'll talk about it next week and see where that underlying market has gone to and where this trade is positioned. So that's it on IWM. So now let's go out and look at we're going to revisit a trade that we did a long time ago. We actually coined this trade, the Doppelganger Straddle in the airlines. It actually worked out all right, if I recall, but we did this way back on May 28th. It was episode 315 of Options Playbook Radio, where we actually went out and we bought a put in one airline, and we bought a call in a different airline. The markets were very volatile, if you remember, back on May 28th, and that was our outlook. So now what do we have? We have very volatile markets, not quite the same scenario, but very volatile markets in the pharmaceuticals. Why? Because we've had some major news about a cure for the COVID. We've had a couple of companies come out and say that they have vaccines that are 90 to 95% effective overall. The big company that came out first was Pfizer, and they said their phase 3 trials were 90% effective. The market took a big jump up, and not to mention Pfizer. Pfizer went up about 10% on that Monday that they announced. And so we still have other companies that are out here that are still trying to make vaccines. Moderna came out with theirs. Johnson & Johnson is also in a phase 3 trial, and actually, we had a couple of senators, Rob Portman, come in from Ohio and say that he's actually signed up for the trial. So there's a clinical trial going on for Johnson & Johnson. We have a few other companies that are out here that are thinking about it. I'm going to look at a fund trade, not meant to be a recommendation, but if Johnson & Johnson also comes out with a 90% or above type vaccine, and we have very good clinical trials with this COVID-19 vaccine, then Johnson & Johnson, I'm expecting a pop, and maybe Pfizer would go down. And we're just going to kind of play it that way. But then Pfizer could go down just because somebody else announces a drug. And hopefully Johnson & Johnson will actually make a little bit of a pop. So we're going to do a long straddle. And part of the reason why is vols have kind of came in a little bit on these stocks, a little bit because the news is already out there. We don't quite know what's going on. I'm not saying they came in a lot, but they came in a little bit overall. And we've kind of had an upward movement in both of the underlying stocks. Johnson & Johnson took a little bit of a pop to the upside also on the Pfizer news. So let's look at this trade. We are going to go out 30 days in time on this in the option chain. So that's going to be the December 18th expiration, which is the normal monthly expiration. Pfizer, as of today, closed at 36.32. It was up 28 cents on the day. But as I mentioned, before the news was announced, it was trading right around 34.50. It's now at 36.32. So it came back off a little bit of the big spike up, and we're going to buy a put in it. I would like these puts to be the same valuation, but Pfizer's a lower price stock. So we're going to go a little bit out of the money, 100% speculation money here. We're not using any retirement funds to do this trade. And with the stock at 36.32, we see that the implied volatility on the December 18th puts is trading right around 33%. That puts the put at 118 by 120. We're going to call it 120. Say we pay 120 for that put, and we're going to buy two of them. Okay, we're going to buy two 120 puts. That's going to be $2.40. Now, at the same time, we're going to look at the Johnson & Johnson out of the money calls. So Johnson & Johnson right now is trading at 147.37, and that also December 18th expiration, and we're going to buy the 150 call. Now that's 181 by 207, a little bit of a wider market, but the market is close. So we're going to call that $2. Let's say we can pay $2 somewhere close to the midpoint on that. And our speculation is going to be that we hope over the next 30 days, Johnson & Johnson goes a little bit up, Pfizer might go a little bit down. There could be some major news from any one of the pharmaceutical companies out there that are trying to come up with a vaccine. The more vaccines we have, obviously, the better in general for the whole world. So that's kind of the play that we're going to look at. And we're going to call it a Doppelganger Strangle, because we're using out of the money options. I'm not going to say straddle at this point in time. So we're going to be out of the money on the Johnson & Johnson trade. The stock's at 147.37. And we're going to be out of the money on the put side with the Pfizer trade, with the stock right now trading at 36.32. All right. So talk about a fun trade. This will be fun to look at. We have 30 days for this to live. So we did have to pay a little bit of premium, Pfizer being around 33% implied volatility. I would really like it to be more towards the Johnson & Johnson number, which, oh, by the way, I might not have mentioned, is right around 20% implied volatility. So, as I said, those have came off quite a bit since the March pandemic. Overall, volatilities are coming down on some of these underlying stocks. We still have the VIX above 20, though, so we still have a volatile marketplace just in general. So let's summarize the trade because there was a lot to it. We are going to do a pharmaceutical company Doppelganger Strangle. In Johnson & Johnson, we're going to use calls. In Pfizer, we're going to use puts. Johnson & Johnson is trading at 147.37. We're going to go to the December 18th expiration, 30 days away, and we're going to buy the 150 call option. We're going to say that we can fill that at close to the midpoint of about $2. We're then going to look at Pfizer, and Pfizer is trading at 36.32. It was up about 28 cents on the day. We're going to use the same expiration, the December 18th expiration date, 30 days away. And we're going to go a little bit out of the money and buy some puts. We're going to buy the 36 strike put, and that we're going to say is trading at about 120. We're going to buy two of those puts so that we have approximately the same amount of capital on the Pfizer side as we do on the Johnson & Johnson side. So it's going to be a 1x2 Doppelganger Strangle in the pharmaceutical companies. It's just a lot of fun. As always, this is not meant to be a recommendation. It's just fun to be able to talk about some of these strategies and some of these things. It worked out pretty well when we look back at the May 28th trade that we did. So let's try it again. We have another volatile sector of the marketplace, and let's just take a shot at it. So that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Please follow me on Twitter. My handle is @BrianOverby. And thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finished out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.